Japan has long been one of the United States' biggest economic and military partners. This is evidently seen in the enormous number of U.S. military bases located across Japan, especially in Okinawa. These bases support American presence in the Asia-Pacific and help maintain regional stability. Economically, Japan is also a top investor in the U.S., with many Japanese companies setting up factories, car plants, and tech offices across the country. In return, the U.S. supports Japan with defense technology and trade partnerships. But there is one more way where Japan has proven itself as America's biggest ally, and that is no other than their holdings of U.S. debt. U.S. debt, also known as U.S. Treasuries, are essentially loans that countries give to the U.S. government by buying bonds. These treasuries help the U.S. fund its spending, such as infrastructure, defense, and social programs. And Japan has consistently been one of the top foreign holders of U.S. debt. Here's a graph on the top holders of U.S. Treasuries as of January 2025, data from the U.S. Treasury Department. Here, one can easily see just how much U.S. Treasuries that Japan owns. They surpass any other economy out there. They hold over $1 trillion in U.S. Treasuries, which makes Germany, an economy that has recently surpassed Japan, seem small in comparison. Moreover, what's far more interesting about the U.S. Treasury holdings of Japan is also the fact that when one compares the GDP of Japan to their holdings of U.S. Treasuries, it is often incredibly generous. Here's a graph on the nominal GDP of Japan, data from the World Bank. Here you can also see that as of 2023, Japan's GDP stood at just $4.2 trillion, which means that their holdings of U.S. Treasuries of $1 trillion are nearly 1/4 of their entire economy. That's a massive proportion for any country to commit to foreign debt holdings, especially to just one country. This level of investment shows how Japan sees the U.S. not just as a partner, but as a pillar of global economic stability. And on top of that, if we graph out the total reserves of Japan, which not only includes these holdings of U.S. Treasuries, but also holdings of other currencies, gold and assets like special drawing rights SDRs from the IMF, we get an even clearer picture of how big their holdings of U.S. Treasuries are. Here, you can also tell that as of 2023, Japan nearly had over $1.3 trillion in foreign reserves. But for their economy to hold over $1 trillion in U.S. Treasuries just shows how deeply invested and reliant Japan is on the United States. It means that nearly the entire bulk of Japan's foreign reserves is tied up in U.S. assets, especially U.S. government debt. But this isn't actually what we want to talk about in today's video. It is well known throughout the world that Japan had always been one of the biggest buyers of the U.S. debt. If we graph out the purchases of U.S. debt by country, we get to see that Japan has always stood out. There was a time when China had overtaken Japan's holdings of U.S. Treasury, but eventually they reclaimed that title back as the largest holder of U.S. Treasury. But what we want to talk about in today's video isn't their acquisition, but rather in the fact that they have actually been selling their reserves as of late. If we graph out the holdings of Japan's U.S. Treasury from January of 2022 to January of 2025, which is exactly 3 years, we get to see that their holdings of U.S. Treasury has decreased from over $1.29 trillion in January of 2022 to just $1.07 trillion by January of 2025. That may not seem significant, but it actually is. That's a drop of over $220 billion in just 3 years, a quiet but notable shift. For a country like Japan, which rarely makes sudden financial moves, this steady decline signals that something is changing behind the scenes. Could this mean that Japan has finally decided to diversify away from U.S. Treasuries? After all, it is not just Japan that has sold a lot of U.S. Treasuries. China, if we graph it out, has been a leading seller of U.S. Treasuries. Could this reduction in U.S. Treasury mean that Japan no longer sees U.S. Treasuries as the safe, go-to asset they once were? Well, to understand the reason for Japan's reduction in U.S. Treasuries, let's talk about the many factors that drive it. The most important factor that one needs to understand here is that Japan's domestic economy faces persistent challenges. despite years of ultra-low interest rates and aggressive monetary easing by the Bank of Japan, BOJ. Japan's growth has been sluggish. The country's public debt is among the highest in the world, a ratio that, in US terms, sometimes exceeds 260% of GDP. In such an environment, Japan's government and major institutional investors, including government pension funds, are under pressure to find liquidity to support domestic spending initiatives. For example, recent stimulus packages designed to boost wages and offset rising living costs have required substantial funding. With domestic fiscal needs intensifying, Japanese institutions, such as the Government Pension Investment Fund and major banks, may opt to sell off foreign assets, like U.S. Treasuries, to generate cash for domestic priorities. This fire sale is not necessarily driven by a lack of confidence in U.S. debt per se, but by an urgent need to free up resources for domestic spending. Put simply, Japan may still believe in the stability of U.S. Treasuries, but right now it needs cash at home more than it needs bonds abroad. Selling these assets provides immediate liquidity without having to raise taxes or take on even more debt. But this isn't really the primary motivation. One can see this as just a short-term response to market pressures. The biggest reason for Japan's reduction in US Treasuries can easily be seen in the value of the yen. In case you're not aware of what is happening with the Japanese yen as of late, let's graph out the exchange rate of the dollar to the yen. Here, you can easily see how much the yen has slid in value against the dollar in the past few years. At one point, the yen had traded nearly 160 yen to a dollar, which was the highest in decades. This weak yen, as the government sees it, is a major concern, not just for import prices, but for national stability. A weaker yen makes imports like fuel, food, and raw materials more expensive, which hurts consumers and businesses alike. While a weak yen can benefit exporters by making Japanese goods cheaper abroad, the downside has started to outweigh the benefits. If we graph out Japan's imports by category, we can even see this more evidently. Here, you can see that for 2024, Japan relies heavily on the importation of mineral fuels, oils, and distillation products. These are basically energy sources like crude oil, natural gas, and coal, essential for powering Japan's industries, transportation, and homes. With limited domestic energy resources, Japan has no choice but to import the bulk of its energy needs from abroad. Now, here's where the weak yen becomes a real problem. Since energy imports are priced in US dollars, a weaker yen means Japan has to pay a lot more in local currency to buy the same amount of fuel. This inflates import costs, widens the trade deficit, and places added pressure on businesses and households already grappling with inflation. So, they can't leave this problem alone now, can they? What the government has done is to counteract these pressures. The BOJ and other financial authorities have periodically intervened in the foreign exchange market. One common strategy is to sell US dollars, or dollar-denominated assets like Treasuries, to buy yen, thereby supporting the domestic currency. Recent news indicates that such interventions have occurred when the yen has been under stress. In many cases, Japanese banks and the government have financed these interventions by reducing their holdings of US Treasuries. This not only helps stabilize the yen, but also signals Japan's shifting priority from earning modest returns on safe US assets to preserving domestic purchasing power. For instance, in April 2024, the Bank of Japan's account balances indicated a probable intervention of approximately 5.5 trillion yen, around $48.2 billion, to support the yen. Similarly, in July 2024, an estimated 3.5 trillion yen, about $22 billion, was likely spent in another intervention. These aren't small interventions. They are worth tens of billions of dollars. Now, beyond these two reasons, there are of course more factors that have been driving Japan's selling of US debt. This ranges anywhere from the fact that they hold too much US Treasuries, which means that they may need to diversify away, possibly buy out gold or other securities. But for now, currency intervention, with a little bit of domestic challenges, may be the primary reasons. But anyway, do let us know what you think. Thanks for watching.